So our next speaker will be Professor Viktor Todorov. Viktor Todorov is currently the Harold Hines Professor of Risk Management and Professor of Finance at the Kellogg School of Management. And he's on the editorial board of Journal of Econometrics and Econometrica, and also is the co-editor of Econometric Theory. Victor is an elected fellow of the Journal of Econometrics and also the Society for Financial Econometrics. So welcome.
We'll continue the topic with options, a lot of option stuff, and I'm kind of happy to see here practitioners and people who actually I get the feedback from them. So this will be a very simple title, Nonparametric Option-implied Volatility, and it will be based on these very short-dated options. And I will show you in a minute sort of the graph and the liquidity of these markets. But let me just kind of spend the two. So it will be a little bit mathematical at the beginning, and then we will sort of go to the kind of what we can use these sort of measures for. As the title suggests, what I'll be after and what I'll try to do is develop a model-free. That's kind of what finance people like calling non-parametric measures. Model-free means that it's robust to any kind of parametric model you have in mind. So that's just basically a non-parametric estimator of volatility. So this has obviously a long, long history. And so if you go back to the first option pricing model, this will be like the Black-Scholes. And in the Black-Scholes world, there's only one parameter, and that's the volatility. And so you can take any option on trades on the underlying, regardless of the strike, regardless of the time to maturity, and you can invert it back and recover the volatility. And so this thing basically, this was for a long time, sort of that's called Black-Scholes implied volatility. Torben showed some of the plots of Black-Scholes implied volatility. And for when the literature started back in the 80s, after the sort of the markets developed, option markets developed, and so this was viewed as actually the competitor to the traditional measures of volatility, historical measures of volatility we can extract. Now, of course, people quickly realized that the assumptions behind the Black-Scholes model are just way off, and as a result, depending on the strike you take, you can extract a different measure of volatility. And if you look at those out-of-the-money puts in particular, you'll see that they're severely overpriced. And there's just a lot of academic literature trying to rationalize this. Now, what has happened recently, however, so the goal of this paper is to come up with a non-parametric option measure in the style of Black-Scholes, but which works even in situations where that model doesn't work, and it's not true in practice. There's time-varying volatility, there's jump risk, and all sorts of things like this. Now, what I will do in this talk is use that very short-dated option. And so here's a little bit of, just to illustrate how much the trading has increased in these options. And again, so the judge for whether this is useful for economic purposes and answering economic questions is how can I relate this back to fundamentals. Okay, that's how, at least for me as an academic, that's kind of what's the interesting question. I do think that you can do a lot of things on the practical side with this too. I'm less interested in that, but I'm pretty sure that this is also the case. But anyways, so this is the trading on the S&P 500 in trading in volume, millions of dollars. It has gone up from 06 to now. That's kind of not that interesting for me, but it has gone up. What is interesting for me is this so-called weeklies, which we talked about, which were introduced around here, and they gradually, so you see basically from 11, they have been steadily increasing, and now they constitute something like 45% of the old trading volume on SPX. So it's just a lot of activity traded there. And do you need a lot of volume for that price to be relevant? No, you don't. But it is comforting to see that actually there's just a lot of interest in speculation in these markets. What has happened since 2016, because that product was so successful for the exchange for CBOE, they introduced the Monday and Wednesday expiration dates. And so when you actually sum up, that's why here you see a little bit dip in the percentage of total volume traded in SPX options for the Friday weeklies. If you sum up those two guys with this, then you are up to 45%. So half of the volume is short-dated options. I think it's a very simple practical reason why this is popular, because you don't need to do hedging. I mean, it's just delta hedging is not necessary here. I mean, these out-of-the-money puts, they're zero delta. And so you kind of, it's just they're very cheap. They're very cheap, but they're expensive in relative terms, but they're very cheap in nominal terms. And you don't do it. You're providing insurance. That's all it is. It's fire insurance. Okay? That's how I view this. What I'll be doing, however, will not depend so much on out-of-the-money puts. We will see in a minute. So let me tell you what's the mathematical question. We'll answer it, and we'll try to kind of make some use of this. Okay. So there'll be an underlying model, and I told you I'll be model free. Okay. But so I know that if there is no arbitrage, the model should be a semi-martingale. That's kind of, so that will be my underlying framework. I'll assume that markets are free of arbitrage, okay, opportunities. And so there's a drift here, there's a volatility process, a sigma, and that's a Brownian motion. So in the Black-Scholes world, sigma will be constant, and that will be just a Brownian motion, which is just Gaussian distributed returns, okay? And then this will be jumps. I will not do anything about these guys. And so that's why I will not tell you, even not bother introducing the notation for this. It's fancy looking notation, but it's just jump risk, okay. I know it's there. I know people care a lot about it, and that's important to reflect it in my, whatever I do in my procedures. I will have to account for the fact that this guy is there, but I want to model it. I don't want to say anything about it, okay. And so the goal, in a nutshell, is from using that short-dated options, which I showed you, extract the volatility. That's basically the goal. It's hidden, it's buried into these options, and I want to kind of unravel the volatility from there. Okay. So just a little bit of notation. So I have an option price O. This is T, capital T stands for time to maturity, and this is the log strike K, okay? And so I'll use, like everybody in this literature, I will use out-of-the-money options for a given strike. This is either the call or the put. And so if the log strike is below the stock price or the futures price, then I'm using the put. Otherwise, I'm using the call. Okay, that's a little bit of notation. I'll just to make things also easier, I'll normalize the initial price to 1. And so the log price is 0. And so that means that when you see a log strike of 0, that means you are at the money. And if you see it negative, that means that the put is out of the money. And if it's above 0, the call is out of the money. Okay. That's just a notation to make it easier. And so what I'll be interested in this, in a theoretical sense, is an asymptotic in which the time to maturity T is going down. Okay. Now, what is happening when time to maturity goes down? It's actually, from a theoretical point, an interesting thing is happening, is that the option price, well, you would expect it to decrease in value, right? Because if you are currently out of the money, which means that if the option was to exercise today, it will be worth 0. Now, if you shrink the time to maturity, less volatility, so it's less chances for it to get back into the money. So it's clear that the option should start decrease in value. It gets cheaper as you get closer to expiration. That's obvious. But what is interesting from a econometric point of view here is that actually that's far from being uniform. So if you are sitting in the tails, the decline in the option price is very fast. It just drop down very quickly. But if you're sitting around the money, actually that decline is much slower. So T, remember T again is the time to maturity. It goes down to 0. Square root of T is much, much bigger than T. Okay, with T is going down to 0. So there's a non-uniform way in which this kind of option surface shrinks down to 0. Another way to see it, I just basically simulated from a standard Heston model, kind of the standard model which people use in option pricing, at least in the academic literature. And so to illustrate this, so I had the time here to maturity starts from, that's a little bit unfortunate because the colors cannot be seen very clearly. But okay, it will be relatively easy to explain. So you have a time to maturity ranging from 8 days to 1 day to maturity, okay? On a fixed day, okay, I'm just looking at options with these different times to expiration. What is happening is this is strike over stock price, and 1 means that you are at the money. Below 1 means that this is the negative tail event you are pricing, and above 1, that's the positive tail event you are pricing. Now, within the model, that's nothing to do with kind of fears or anything. It's just within a standard model without any kind of special attitude towards tail risk. You will see that thing happening naturally, that as time to maturity gets closer to 0, that the fact that these options become very cheap, the flip side of this is that the implied vol becomes very, very high. And you see almost no change around the money and huge change out of the money. But that's just coming within any normal model. This is going to happen. And in fact, if you keep shrinking time to maturity to go to 0, this thing will converge to, it will explode here, and it will stay to a constant number. So it will look like a Dirac function. Okay. All right. And so now what we want to do is we want to extract the model-free measure of volatility. Now, it is clear from here that the true level of volatility here was somewhere around here. And all of that here is just reflecting that kind of jump risk which is built in the model. And so if I was to tell you, if you were to pick one strike, which is the strike you will pick that contains the most information about the volatility, well, that strike will be at the money, right? Because this is, so you are sort of at the money, it's intuitive, you are very sensitive to small perturbations in the price will get you from out of the money in the money, right? Just a small tiny change will get you to the money. While here, the only thing which can put you back into money is some big kind of event realization. So that's like, these are like insurance, right? Fire insurance, okay. And so if I was to choose one option with one strike, the best guess will be at the money. And in fact, if you go back in history, so the way the so-called volatility index, VIX index, and CBOE is quoted, they started off with at the money, Black-Scholes implied volatility. This was their measure of spot vol. Okay. And so if you do this, in fact, you can sort of do the expansion a little bit more formal. So you can do it also for options with strikes which are very close to the money, not exactly at the money, because you probably won't have exactly at the money options. Because, you know, discreteness of the strike grid, okay? So you can do that expansion, it's very easy. And I simulated it in a model which is kind of a realistically calibrated model to the option data. And so it's a simulation. And so the blue line here represents the true volatility, the spot volatility, which is changing over time, okay? And the dashed line is the volatility which you can extract from the options which are at the money. Okay, so this is Black-Scholes at the money with 2 days to expiration. Very short-dated options. Okay, and you see what you get here is a significant bias. So very, very biased is basically the bias is close to 50%. So that's kind of huge. And so, you know, you're just basically at this point, there are 2 solutions. The one is to give up on a non-parametric measure. You know that theoretically it should work, but for realistically calibrated data, it actually doesn't look that good. Okay, so that's the one option. The other one is to say, well, Black-Scholes at the money implied vol is probably not the best way to extract the signal about spot volatility. And so I wanted to entertain a little bit that second idea. And so here's a very nice result. If there are those of you who are doing options here, so they will find it familiar. And it's a long literature in finance, academic finance, about extracting in a model-free way risk-neutral moments. Okay, and the idea is very simple, but here's what I will kind of make use of this. And so this is this paper. It comes from this paper by Karen Madan, but again, early ideas they were from Steve Ross and others who are doing exactly this sort of thing. So you're looking at the risk-neutral moment of a function which is smooth of the terminal price. Okay, so x is the underlying, and t is the expiration date. So you're looking at the risk-neutral moment of some smooth function, and you can span it. So that's kind of derivatives terminology. You can span it by a portfolio of options with strikes which range from -infinity to +infinity. Just to remind you, little k here is the log strike. So if it was the log strike is from -infinity to +infinity, the strike is from 0 to infinity. Okay. But this is so it's a portfolio of options because you're going through the whole strike range of the options, and you have the option prices here, and this is a known function. That's the second derivative of the function, which you know. Okay, and so you're kind of weighting the different options depending on what moment you're trying to extract from the returns. You will weight them differently. And so this result, as I said, it's an old result by now. And it's just basically, just as an aside, if you look at the VIX index, the volatility index on the CBOE, the function which they use to calculate it, it's this formula with the function being the log. Okay. And that basically gives you the VIX index. It measures the total volatility. Okay, so now I'm more academically oriented, so now I'll kind of do something. So I'll ask myself now, can I basically find a function which is here, which will connect conveniently with the spot volatility of the asset? And the answer is actually very simple, because the risk-neutral distribution of the return can be conveniently summarized by the characteristic function. So I can apply that general formula with that specific function, which is the characteristic function of the return, right? It's very easy. Here it's an explicit solution of that portfolio. I stands for the imaginary part, so I'm not looking at imaginary portfolios. They're real, right? Just have the real part and the imaginary part, but they are option portfolios, right? So it's super simple stuff, okay? And now, if I'm looking at where is the short-dated options coming into play, well, they're coming into play in the following sense. If I'm sitting and I have very short-dated options, they actually, you can pretend that volatility was constant over that short interval of time, okay? Because you're also looking at expectations, so there the change is kind of small. And if you pretend that volatility is constant, but then the return, so that the stock price becomes a so-called Levy process, which is basically a process with IID increments, okay? And there's a nice, beautiful result which links the characteristic function with the volatility and the jump intensity, okay? And that's the Levy-Kinchin formula. Super easy. And now I'm interested, remember, my interest is in this guy, sigma t, and I want to do the estimation of sigma t, knowing that there is jump risk, knowing there is a drift, but I want to kind of minimize the error. Okay. And so how would I do this? Well, let's just first look at, well, I mean, if I look at the real part of that portfolio, that will kind of single out this guy. It will get rid of this automatically, and it'll take a real part coming from here. So just to write it a little bit more clearly, if I take the real part of my characteristic function portfolio of the options, okay, that will give me the true volatility plus a residual. That residual is the effect of the jump risk. And so now I want to minimize this thing. How would you minimize it? Well, if you look at this, there's nice things about trigonometric functions. They are bounded, okay? So that's just bounded by a constant. I'm dividing by u squared, and u is the argument of the characteristic function. And so then you ask yourself, I want to make this thing as small as possible. So let's just pick u very large, which is the argument of the, remember, u is the argument of the characteristic function. Let's just pick u very large. You pick it very large, and there's an analysis behind this, which I will not kind of get into, but the optimal thing to pick is u, which is of order 1 over square root of t, where t is the time to maturity of the option. Why is this? It's kind of, it's not a very difficult analysis, but let's just kind of, in the interest of time, I don't want to sort of waste too much time, spend too much time on this. That's the optimal kind of rate at which you should pick the argument of the characteristic function. Okay. When you do this, what is happening? Well, here's the first result. The volatility is actually, this is the thing, okay, again, just to remind you, this is the thing which I can observe from the data, because this is constructed from options. I'm interested in this guy. I'm making, when I use this portfolio, I'm making an error because of this guy, okay, which is the jump risk. And the error, however, is of order t. Okay. Now, if you go back to the add the money Black shows, the error, okay, so this is not, okay. So if you go to the Black shows option price, the error, you know, just pick k equals to 0. That's the add the money exactly. So this guy is the density of the normal. This is square root of sigma t. this guy drops out, and this is a further t. So the estimate of the spot volatility coming from the Edelman in Black-Scholes has an error square root of t. The error which I got here, the bias, is of order t. So actually, theoretically, I made a big improvement. Theoretically, I don't know whether in practice that's a good thing, but kind of how good it is in practice. But theoretically, at least, I actually reduced the bias, and you can actually show that's the best you can do. Well, if you allow for, depends on kind of how general the dynamics you allow for the volatility. But in the general kind of the typical kind of dynamics which you're thinking of for volatility, that's the best you can do. That's the best thing theoretically you can do. See how it looks on simulated data. So this is, remember, this is a portfolio which depends on u, which is the argument of the characteristic function. When I pick u equals to 0, then what I measure is basically, you can show it's the VIX, which is basically the sum of the volatility plus the volatility which comes from the jumps. So you measure the whole thing, the whole return volatility. When I start picking u very large, what you are measuring is only the volatility which is due to the kind of regular moves, not those extreme moves, but the diffusive volatility, okay? And so what you have here with the two lines is, this is extracted from options with 2 days to expiration, and this is with options with 5 days to expiration. Now, obviously, you're much more precise. You're much more precise if you're using closer to expiration options, but you also, I mean, you're reasonably precise. I mean, this is realistically correlated kind of option pricing model, even here. So now, this is only about the bias. I didn't introduce error in the option in the measurement, noise in the measurement, okay? But this is just to see whether you can have control on the bias. So if I can actually measure reliably with little noise option portfolios corresponding to this u, to this argument of the characteristic function here, then actually I achieved something. I achieved something very good. I should say as an aside that, of course, you can actually now introduce a little bit more structure to the jumps, and you can debias and do all those kinds of things. But I want something which is very simple and with as little kind of manipulation as possible. And so I will kind of restrict myself not to debias and do all those kinds of things. Okay, so this is what you can do here. Now, let's see how I'm doing with time. Okay, so all right. So now what I will do, I will skip a few slides in the interest of time, so I kind of spare the details, because the critical part here is to pick the right u. You should pick very high in a way that kind of minimizes the bias. Okay, but it should be not too high so that it's not very noisy, because the higher the u, the more noisy it becomes to extract the signal from the data. And this is like any of you, if you have worked with empirical characteristic functions, will sort of know that the higher values of u is just very hard to kind of disentangle this kind of the high frequencies, if you want. Okay, so I'll skip that detail how you do this. Believe me, it's not that difficult to do. If you add noise to the data, okay, so the plot I showed you before had no noise. Now I just add measurement error, which is kind of realistically calibrated on the basis of the bid-ask spreads, which you see in the option data. So in fact, I probably here slightly exaggerate the amount of noise, because what we see in option metrics for the CBOE options is actually much larger than what the market makers are posting or kind of in the pit trading. So you can probably, this is a little bit exaggerated, but it still illustrates this point. Now, if you stare at so this was in simulated settings, so I know that the true volatility is this dashed line, okay? And you see now that unlike before, which I had a nice and smooth function, which was kind of declining monotonically, now the noise kind of made those waves. And whenever you see those waves, just telling you that you are making a Fourier transform of noise. So that's pretty much, you should stop here, because it's just exhausted all the information in the data. Okay. And so there is a challenge in this extraction, but I don't think it's, but it's sort of, there is hope that you can also do it. Okay. So I developed in the paper, it's not very difficult. I developed a procedure where you kind of adaptively choose the level of u. So you choose the level of u according to an estimator, initial estimator volatility. That's not very difficult. And then you actually, and then you have your estimators. I'll skip these details here, how this thing is done. here's just an illustration of probably what goes into this thing and what you get out. Okay. So this is the option data I'm going to use. Unlike before, because the option portfolio I constructed consists of just goes the option prices directly, not the Black-Scholes implied vol. So I plot it in terms of option prices. Obviously, what you see here is on that day, this was the 20th of January 2016. So what you can see is this is at the money. So the level of the index S&P is 1860 or so. It's amazing where is the S&P 500 today, right? And so it's how far we should have shoot it up, even after the correction, but that's a different thing. So this is this. You see a lot of interest on the left tail. I mean, there's just a lot of the action, the available strikes that there was trading was much of it is here. It's just interesting to speculate on that stuff. And different people will have very different views on what's reasonable, what's not there. Okay. But anyways, in relative terms, this is way too expensive relative to this, right? This is super cheap, this is very expensive. Okay. Now, let me just, I'll go back to the slides just to remind you one thing here, which is sort of, important before I show you the next slide. So remember where I started building this estimator is I started from the idea that I will take the real part of this characteristic function portfolio, and the hope was that this guy will go away. Okay. So now I have to, for this to happen, however, I just have to evaluate, I have to use an argument of the characteristic function which is very high. So, and the idea is that when u is high, you see this guy becomes large relative to this guy. It's a bounded function. So this guy is bounded, this guy is not. Okay? And so, so in relative terms, this becomes much bigger than this. So if I have picked u correctly, what should happen basically is that this guy should be close to 0. And in particular, I obviously for the real part, I cannot gauge this because I suit the sum of the two things. But if I have picked u high enough, the imaginary part of this portfolio, this guy here, should be close to 0. Okay, so that's an indirect test. Okay, so that should happen. Now, it would have been 0 also if this was very symmetric. But in practice, you know that there's so much concern on the left tail that this guy is very, very skewed to the left. In fact, some people will shut down positive jumps, and they'll only model negative jumps. Okay, and so now let's go back to this kind of data and what you see when you do it on this data. So this is the data I feed into this option portfolio. And now I give you for this level of u, which I picked adaptively for the characteristic function, the real part of the characteristic function and the imaginary part of the characteristic function. And that kind of tells you what goes into this. When I sum those, when I integrate this thing over the strike, which basically means I sum this thing up, I get my estimator of volatility. Okay. Now what you see here is kind of what goes into the whole calculation. You will not be surprised that most of the weight in that portfolio is from the at-the-money options, right? You see, it's like the weight here is at the money, and once you start getting out of the money, well, the signal about volatility is gone. And so you are doing exactly what you should do, basically ignore this out of the money options and just focus on the stuff at the money. But the way you're focusing, you're not just picking only at the money option price like the old VIX, but instead you're kind of integrating out all this kind of stuff locally around 0. Okay. Now, what you also see here, this is the imaginary part of that portfolio. If I've picked u high enough, that guy should be close to 0. And it is, because all the asymmetry which you see here, this large left tail, that's close to 0. In relative terms, it receives very little weight here, okay? And so that doesn't matter. The symmetry here doesn't matter. Locally, at the money, around the money, the option price is symmetric. So you see kind of symmetry around here. And that's basically what delivers exactly sort of when you integrate this thing over the strikes, this negative part cancels with this, and you get something which is very close to 0. And that tells you that intuitively, you basically picked just about the right u where you don't have anything coming from the jumps, the thing is kind of minimized. And so what the option estimator volatility will be coming from here. Okay. So now, let's see. So I want to go also to the finance application. So I will just tell you one thing here. Now we have to basically, you can develop a central, econometricians, they like central limit theorems, okay? So, we will kind of have a central limit theorem for the volatility estimator, which will kind of give us confidence intervals. We will build confidence intervals. But for this, you have to basically have a measure of how sensitive your estimator is to noise. And this is just a very simple way to do this. In any realistic model, the option price should be smooth function of the strike. As long as you don't have probability masses at given on the return distribution, which you will not in the models we are kind of interested in. In that case, the option price is a smooth function of the strike. And in fact, if you look here, this seems exactly kind of the case, right? You don't have too much sensitivity. It looks like a smooth function. You can nicely draw a smooth function. Okay, and so then what you do basically, your measure of how sensitive is the volatility estimator to measurement error is to look at the difference of the option price to the average option price you get from the two neighbors. Okay, so that should be very close to just a measurement error. So that will give you an idea of how big is the measurement error. Okay, there are other things we can do here, like bootstrapping and all sorts of things like this. That's kind of, in some sense, let's not worry about this. That's kind of the idea where you get the estimator volatility. When you do this, under some assumptions, I didn't tell you much about this, so I don't want to get into this. You get a nice limit result which you can directly apply to quantify precision. So this is your estimator volatility. This is your spot unobserved volatility. So this is the object of interest. This is the feasible thing you can get from the data. This is a measure of the standard errors. Okay, so that's kind of which you construct again. This is constructed from the options only. This is constructed from the options only. And this is the guy I'm trying to learn about. I don't observe. And you can actually, with this limit theorem, of course, you can construct confidence intervals and sort of, or makes the formal statistical inference. Now, I'll tell you one more thing, and this is for those who do high-frequency econometrics. This result is very nice because it holds also jointly with a high-frequency estimator you can construct from the volatility, from the returns. Right? I mean, the kind of the classical thing which Merton told us back in the 80s and which Torben and Tim have pioneered in finance 20 or more than 20 years ago, right? It depends on how you count, okay. But, where you just basically look at just the intraday volatility during the day and you get an estimate of the spot volatility. And so if things work okay, then this estimator volatility should be not very different from the ones you get from the returns. And that's ultimately the test for me, whether that thing is garbage or not, right? If you actually get that consistency, that's just telling you that the markets are perfectly synced. There's a lot of going on stuff, right? I mean, people will say markets are disintegrated. It's just, like all these speculators there on the option markets, nothing to do with the real world. They're just betting against each other and that's it. And so it's a hard test, So I was kind of initially scared sort of going and implementing this thing. But we'll see what happens when you put it to the data. In any case, theoretically, inference, asymptotic inference, it's very nice. It's a joint limit result. Okay, so now I'll kind of switch to a little bit of application. First, I will show you how it looks on the data. This is done with a little help, or maybe a lot of help, from Yang Zhang, who is a RA in our department, and is very good working with option data. Very, very good. So, okay. Here's the data which we used. So the short maturity option data we used, period is from 2007, from August of 2017. And obviously at the beginning we didn't have the weekly, so they were just not liquid enough to kind of use them. So we used whatever was available, kind of short-dated option, okay? The shortest maturity which was available, that's what we used. The median size of the option cross-section is 59 out of the many options, which is actually pretty good. It's a pretty wide cross-section. And then we will kind of benchmark this against the traditional return-based measure of volatility, which will be done maybe a little bit conservative, but I think rightly so for good reasons. We'll use 5-minute returns. So we will use 5-minute returns, and we will use, what did you say, Torben? 22 hours and 15 minutes. Okay, so I rounded here to 23 hours. It's amazing. This market is so liquid. Futures market on S&P 500, it's almost 24-hour trading. And so I will very liberal, I will use the word local window, in a very generous way, but this is just to give a chance for the return-based volatility estimation, because there's just a lot of, it's just very difficult to recover otherwise precisely volatility. So we'll take the whole 23-hour trading period, and I will call, so we will observe options at market close, which is 3:15 Chicago time, okay? And I will take the 23-hour leading to that high-frequency 5-minute sample returns to measure this from the high-frequency data, and I will compare this with my option-based estimator. Again, in the textbook material, which we teach in finance, the two measures of volatility should be very close. If I have done a good job of separating jumps from volatility in the option data, I should get the two measures to be actually close to each other. So here's what you get when you do this exercise. So I need to tell you what is what. So you have two lines. Well, one is dots, the other one is line. So the line, which is the black line, is the option-based measure of volatility, and the dots, which are gray, are the high-frequency based measures of volatility. So this is the measures. So the traditional measure, if you want, of volatility is these gray kind of dots, and the black line is the one I extract from the options. Well, I mean, I kind of, well, you'll be the judge, but I think that it's pretty good, or at least it exceeded my expectations, because the first kind of if you zoom out and kind of on the big picture, you're nailing the levels, which is absolutely magnificent, given how difficult it is to separate volatility from jumps, both from the returns and both from the options. And so that's kind of almost suspicious. And if you now okay, so if you the second observation on the big picture is that the black line is kind of in the middle of the gray area, right? It just tells you that the black line, which is the option-based measure of volatility, is way more, way less noisy than the return-based measure of volatility. And in fact, I mean, the standard deviation is a factor of 2, so it's like a big improvement in that sense. Okay. Now, okay, so if you stare, however, deeper, if you look longer at these options, at this data, then you will see that you will probably criticize me, yes, there is a period, and I'll be the first to admit that if you look at 2009 to 2010, well, then the black line is consistently above the shaded area. I don't have a good idea what happened exactly there. The only thing I can tell you there in our defense is that we don't have these very short-dated options at this point in time, so we are using a little bit longer-dated options where the bias, so we are a little bit upward bias. That's probably what happens. You will also see a lot of spikes in the volatility measure, high-frequency volatility measure, which are not always matched by our option estimator. And so, for example, this spike here or this spike here, I went back and checked the data, and the high-frequency data, what were those spikes? These spikes were the Brexit, and this spike was the US election. And so they were very short, they were one-day kind of episodes. But these are exactly the times when the high-frequency estimator, when you think about it, will struggle. Because volatility probably changed very much over this 24-hour period, which you're using to estimate the volatility. And by the time you look at market close, the volatility just moved on you. And there's no way, you don't have enough data on the returns to estimate that thing accurately. And so in that sense, that made economic sense to me. All right, so now I'll look at two applications of this thing. So the first thing to see, purely practical thing, forecast volatility. A lot of people care about forecasting volatility. So And what I will do here will be very simple. So I will look I don't want to get into a race to get to the best forecasting model because there is a different game going also there. I mean, actually, a model which is misspecified can do a better job than a correctly specified model which is hard to estimate. So these kinds of things. So I don't want to get into that. And so what I will do instead, I will look at the standard model which people, at least the academic literature, views as the best kind of model to forecast volatility. And I will augment that one with the option data I have. And let's see how much improvement I get. So that's in some sense, for a practitioner, I would think that that will be a test of how this data is useful, right? Or at least I would think so. So this kind of, the model which people sort of, Torben alluded to, people like in this literature now, it's a reduced form model, but it mimics well kind of the types of volatility dynamics we think underneath. And so you're forecasting something. And so in this case, I will forecast either total volatility going forward or only the continuous volatility without those kind of tail events happening. So I can forecast either of the two, okay? And what you do is you use today's level of volatility, you use the level of volatility over the course of the week, the past week, and over the course of the past month, okay? And so if the model was kind of a one-factor model, a Markov model, in that case, the today's volatility is enough sufficient statistic. But you know that volatility sometimes is exposed to high-frequency shocks, low-frequency shocks. I mean, probably right now, arguably, you're experiencing a high-frequency volatility shock, which we currently have on the markets. That thing will go away within a week. In that case, today's volatility is probably not a good predictor of volatility forecasting in the next week or the next month. We want to also kind of anchor to what the volatility did in the last month, and it will kind of give you a little bit better idea of the long-term sort of volatility. And so that's the reason kind of to intuitively explain this thing. So that will be my benchmark model. A lot of work has gone into the academic literature on forecasting, and those guys have shown that this actually model beats a lot of like Garch, right? I mean, that's kind of the academic the practitioner's kind of choice probably. So that thing beats very easily sort of a Garch type model. And so I will look at the alternative, which will be basically what I will just add my option-based measures. Okay? And so that will kind of give me sort of, let's see how much of an improvement I should get. If all I'm putting there is garbage, that thing should go away. But if it's not, then I should actually have it improve. And so I'll use two criterion for forecasting. The one is a mean squared error, and the other one is quasi-likelihood. So intuitively you can think of this as the squared error, kind of the squared forecasting error you're trying to minimize. And here you're trying to forecast, the benchmark here is the relative error, right? You put a percentage, so you kind of downweight a little bit the big, matching the big volatility spikes. You just, in relative terms, you're seeing how much you're kind of improving. So I normalize things because I find it hard to interpret these numbers otherwise. So I normalize the mean squared error of the HAR model based on the high frequency based measure of volatility. And this is the mixed model which as the options. And what you see here is actually and I use in the forecasting window, I use either a rolling window or I use an increasing window. And there is an argument why you should be doing one or the other, so we do it both. And you see something like an improvement of around 20%. 20% is big because these models already are beating a bunch of alternatives like the Garch. And this is so simple to calculate also. This is super easy. You don't need a PhD to do all these kinds of calculations underneath this. It's just basically there are a few lines of code and that's it. And so such a big improvement I thought that this was kind of a non-trivial thing. And that will be, for me, the ultimate test of whether this thing is useful or not, right? I mean, you're looking for signals and predicting things. Okay, that's the one application, but now, because I'm a little bit more theoretical, we'll go to another application. This is the forecast error, the density of the forecast errors, but let's not spend this kind of time. So basically, I'll finish this with a little application on portfolio allocation, okay? So this is more from a theoretical point of view. So there's all that work, the traditional sort of way in asset pricing is to view the economic agents, people like you who trade, like the superhumans. So the ones that know everything, so they know the volatility, right? And they know the parameters of the model. There's absolutely no uncertainty about anything. But if you think about it, you actually also have a lot of time and a lot of disagreements of what's the right level of volatility. So what I want to do basically now, I want to make the agent in the economy being an econometrician as bad as me, or as good as me. I don't know, depends on the interpretation, your interpretation. So basically, what I will kind of look at, this agent will try to optimally allocate between stocks and bonds based on imperfect information. So he will not observe directly volatility, but he will only have noisy signals about volatility. Okay, and so this is a kind of a this is just for illustration. There is a one-factor model. Volatility, so for the return prices, so you have the volatility, this is the normal moves, and this is a kind of big kind of jump moves, okay? All right, and so as I said, instead of observing directly the volatility, you will have imperfect signals, just like the ones that we were extracting right now. So you'll have the volatility, and then you have a noise. You will not observe it exactly, but you will kind of have a noisy version. And so what we will be interested in is what's the effect of that noise, of that basically, what is the effect in economic terms for making the agents be econometricians? That's in a nutshell what we will try to do. And that will be by basically, what's the effect of having noisy signals on the portfolio allocation? These are kind of normals, because the asymptotic theory behind the volatility estimators is telling you that this should be a kind of, the deviation from the true volatility should be just perturbed by a normal kind of Gaussian shock. Okay, and so the wealth, which you start with something, you allocate pi, omega, you put into the bond, very simple, and then the rest, omega you put in the risky asset, which is the stock market, and then the rest you put into the bond, okay? A risk-free bond. Again, nothing fancy on the preferences, so we will use constant relative risk aversion with some coefficient of risk aversion gamma, okay? And so the portfolio problem then, what you are solving is the following. You're trying to maximize expected utility over terminal wealth, so there will be no intermediary consumption. This is very short, so this is like a 1 month I will look at here. And then, but then you are doing it in an imperfect information setting, in a setting in which you have only noisy volatility signals, right? So the traditional finance kind of academic literature removes the hat and then pretends that you observe directly, that economic agents observe directly volatility. Okay, now if I can observe directly volatility, the only thing which matters in this model is the current level of volatility, because it's a Markov process, and so that's today's volatility is a sufficient statistic. Because I don't observe exactly the volatility, what I need to do, I need to filter the volatility from the noisy observations. So I have a filtering problem, and because volatility, I know it's a persistent process, actually observing a history of volatility signals will help me figure out what's today's level of volatility. And so you can actually formalize this thing. It's not very difficult. You can, the filtering volatility is, the filtered volatility is just some normal with a mean and variance, constant variance, and a mean which is determined from your today's level of volatility, and a little bit of correction for the fact that if you're too far, if you receive a signal too far from the mean of volatility, you will correct basically towards the mean, because you will attribute this thing to noise, right? So that's kind of the intuitive thing which you will do. All right. So here's what you get for this forecast for this filtered volatilities. So what I did is I simulated the volatility path. And I shut down the noise over all days but the last day. So on the last day, I just perturbed volatility, gave a noise, which was -3 standard deviations. So really negative shock, 0 noise, and +3 standard deviations. And so what you see, these are the filtered distributions. Basically, distributions in which I have the black line corresponds to filtering volatility from the high frequency return measures. And the one here is the other line, the thin line is the one from augmenting this with option data. And obviously, you are less confused. You are less confused when you have this more precise option data about volatility. But there are two things which happen. And one thing is you get a bias. So if you have a big negative shock, you get a biased distribution of volatility. So you see this is the true volatility, the dashed line, and you're biased, but you also have a lot of dispersion. Okay, there's these two effects which happen. Okay, so I think I should be kind of wrapping up because see people going out, and I think I'm also running out of time. Okay, so we calibrated this thing. So here's a long story short. This is the percentage of initial wealth invested in the stock. So if there was no noise in the system, you will allocate for this particular parameter setting, you will allocate 60% of your wealth into stocks and 40% into bonds. Okay. And this is the allocations you will get for different levels of noise in the system. So the dots correspond to the observing the high frequency volatility measure, and the solid line corresponds to improving your volatility signal with the option data. So that's just to quantify how much in real terms is the benefit from getting a more precise signal about volatility. And one thing which you can see basically is that there are huge effects in terms of portfolio allocation. So if you see here, the optimal weight is around 65%. If you receive a very big kind of, if you very big negative shock in the observation error, you go up to 82%, which is kind of big change. And if you receive a very big positive shock, you go down to 52%. What is happening is the more precise signal about volatility is going to make the line becomes flatter, so you are less sensitive to this kind of big observation errors just because you have a much more precise tool to kind of measure the volatility. So in general, there are two effects here. One is bias. The bias of the distribution here, if your distribution will be biased on the low side, so you will be thinking volatility is much lower than it was, and as a result, you will be very bullish about the stock market. You will put a lot of weight into the stock market, and here is the opposite thing. In general, if there was no bias, which is the case when the signal was zero, what happens is that if you integrate out the sort of the uncertainty about volatility, your return distribution becomes fatter-tailed, okay? And as a result, there is a small effect coming from this, which is to lower your investment on the stock market. But that in relative terms is just a very, very tiny correction. The dominant effect here is by far the bias. And that kind of tells you that actually for many of the economic models, there will be a big effect coming from making the economic agent be an econometrician and not observe everything perfectly. You can also cast it in terms of utility losses and stuff like that, but let me just not get into this. Instead, I will just wrap up with this. Yeah, we proposed a option-based volatility estimate. So this thing is really, I view it as the counterpart, if you want, of the high-frequency volatility estimators, which we have worked on for, I don't know how many years now, 10, 15 years, and we have very good understanding. I think that the short-dated options provide us a very convenient way to extract measures of volatility, non-parametric measures of volatility. They are very simple. In practical terms, they end up with portfolios of options which are explicit, simple to calibrate, and all they do is just average in a particular way options around the money. Okay, that's basically from the short-dated options, and then you can do a lot of things with these option portfolios. We kind of I showed you two applications. I think there are many more which one can do. All right, I stop here, and thank you.
I can
Okay.
So you compare your new way of estimating diffusive volatility.
Right.
So and then you compare with this high frequency data based on return.
Right.
Does that one include the jumps?
No, that's field. Oh, I didn't mention that.
Yeah.
Okay, sorry. Yeah. So that the measure of volatility from the returns is actually, it's a very simple estimate. All you do, you look at the returns and say if there is a more than 3 standard deviation move, that's a jump. You filter those out, and that's your estimate of robust to jumps kind of estimate of volatility.
But that's a little arbitrary.
Well,
2%.
well, I mean, I don't know, what do you mean?
So you have to say something about which one is better, right? So right now you just have a graph showing that they're different. The high frequency
Right.
based one has
Okay, so
jumps there. So I thought.
No. Okay, so let me just. Okay, so these two measures,
right.
they are supposed to measure the same thing. So both measures are robust to jumps. So they kind of kick out the jumps.
Okay.
They do it in different ways. In the option surface, you do this by kind of mixing up the options in a certain way, so which kind of neutralizes the effect of the jumps. In the high frequency, it's just done. The simple thing, which you would think, you just basically truncate or just get rid of the outliers in the data.
There's other ways of getting rid of jumps, right? There's some non-parametric estimate of jumps, right? So you can probably do that.
Right. And in fact, I mean, yes, but I didn't want to go I wanted to do what most people will do, so not to deviate in that sense, or not to innovate on that. I have a particular view, and I think that actually you can do the empirical characteristic function-based estimator of spot volatility too from the high frequency. So I've done some of my research. I think it's better, but I didn't want to get into this because
I know, but just based on this graph, how can you say anything about which method is better?
Okay. So now, so that's fine. So the graph, I told you, so the first thing which you can do is, because you have statistical kind of joint asymptotic limits for the both estimators, you can test whether they are the difference is statistically different from zero.
Yeah.
That will be a test whether the two markets are perfectly integrated.
Yeah.
And if you do this, most of the time you will actually, your test will indicate that the two are not statistically different from each other. Which one is better? The answer is, well, let's see, politically correct, both. Because if you think that they are actually, no, it can be both, because I will tell you why. Because the source of error, measurement error in the two estimators is weakly correlated. And so you are better off combining the two. Okay. And the weights should be according to how precise are the two, right? You will put more weight to the option just because the standard errors of that one are much, much smaller than the high frequency one, but you will still actually put some weight to the high frequency one. And that's because, it gives you an independent signal of volatility. And so you should actually combine them. Yeah. But my rough estimate is like 2/3 goes to the options, 1/3 goes to the high frequency. Yeah, that's kind of from the optimal kind of calculations.
To follow up on that, you show that it's better, right, by doing the forecasting.
Right. That's the practical side, right? Yeah.
So he took this as input and showed you could
forecast for what?
Forecasting future volatility.
But you don't observe it.
Well, I use them. No. So I use so in that sense, I gave the high frequency data the best chance. I use future realized volatility on the market, which is computed from the high frequency returns. And so for that thing, you are much better off using the option data. Even for forecasting the high frequency own return volatility, you're better off using that measure. So in some sense, this is kind of goes back to this kind of, there's an old literature in theoretical finance again on, forecasting volatility using options and high frequency returns. And the option forecast is usually, the option data is a biased estimator of volatility, but actually can do a better job and all this kind of discussion. So this kind of revisits, if you want, that type of problem. Yeah.
I have a related comments. So since we talk about this, option-implied volatility and the realized volatilities, it seems I wouldn't conclude that the options-implied volatility is better, but I think it's definitely helpful. Right? Mm-hmm. So by showing this predictive power, you're saying that a combination of realized volatility, high-frequency measure, and the option-implied volatility is better.
That's right. The combination. Yeah.
Right, and then from the central limit theorem, you have the stable convergence, and then you have stable convergence of the realized volatility. Mm-hmm. And then, as you say, there's a weak dependence between the two. Maybe we can have combine the central limit theorem of the two, and then
the optimal, and then exactly,
right.
And that's right. And the optimal estimator in that case will be a linear combination of the two, with the weights determined by the standard errors, right? Estimators. That's exactly right. Yes, that's yeah.
And maybe just curious about the pictures. Maybe
which one? There's one picture here.
If you build a confidence interval out of your central limit theorem, based on the option.
On the options, yeah.
Right. Then how big is it?
I don't. I don't. I mean, I don't know. This was. I mean, I know that if you do the high frequency one, especially in these periods, it's enormous. Look, in some of the days, like for example here, you actually, I think that you can reject probably the null. The two things are integrated perfectly, but you know. I don't think you will be very far from rejecting. I mean, it's just if you just stare at that plot, I mean, it looks like the black line is passing through the kind of sitting in the middle kind of that one. Yeah.
It's just really a commentary. So first of all, they shouldn't necessarily be the same because you're using 23 hours. So as you said, volatility can change quite a lot. And some of those days it was just absurd volatility over some hours, and they kind of calmed down a little bit. So you wouldn't expect those extreme periods, the high frequency volatility estimator, to be a good spot estimator. You know, the 23 hours is a lot. Mm-hmm. So more general comment, because we had this discussion before about academics versus industry. These first model-free measures in the Kamadan paper is Ka is an academic who has been much more practitioner since then, worked in JP Morgan, Bloomberg, was running the research side of Morgan Stanley for a number of years. He introduced this measure. He still works on VIX implied stuff. The whole VIX measure came from industry, but by financial engineers, financial mathematicians, who wanted to trade volatility and figured out you couldn't use Black-Scholes implied volatility to come up with a good volatility measure, and they came with this option-based measure. So this type of work, to some extent the previous one I presented, but this in particular, is really the interaction of people who are both academics and leading people in industry who are putting millions of dollars in play. And that's kind of a fascinating area to lie in, I think. But Peter Ka is a very good example of some of these things, and he's kind of in here a little bit.
Any more questions, comments? If no, then let's thank both speakers of today. Very nice. And
Thank you. Thank you.